Traders, welcome back to another video about price action trading. We're going to talk about how to identify high probability setups following price action rules. Now today was a very difficult day to trade, and speaking about high probability setups, there were very few high probability setups that we could have capitalized on following price action rules. A lot of congestion areas, a lot of consolidations, a lot of V-shaped reversals, and overall the structure was extremely slow today. You had to be really patient, and there just weren't that many good opportunities for us to find setups. Just one of those days where it occasionally will really be slow and you will have to fight for one good high probability setup a day. But before we're going to talk about high probability setups, I want to talk about specifically how to identify the market structure and the direction of the market, because as price action trader, you today were confronted with a couple of decisions, and the first decision is paying attention to this trading range and possibly thinking about buying the low of the trading range, and then once prices hit the low of the day, possibly about looking for reversal and going long too early. Now all of these ideas are not wrong, but we have to take into consideration what is the market structure, and we're going to talk about a structure that is called a bearish imbalance. For us to get a better understanding of what we're going to talk about, we're going to take a look at examples from the past, because I found a couple of examples from the past where the structure is very similar to what we had today. And because price action patterns and technical analysis repeat over and over again with statistical reliability, we can learn from the past and we can predict what's going to happen in the future. So now that I'm looking at the structure and it's looking similar to structure we had today, just on a larger picture. And now I need to identify what kind of structure it is. So I'm going to identify my low of the day and the high of the day extremes. And right from the get-go, I see that the structure is not a strong uptrend, is not a strong downtrend, but it is a trading range. And in trading ranges, I monitor health of a trading range or if there's imbalance. And what I can see that since we bounce from the high of the day, we constantly keep creating series of lower highs. Now this is what it's called a bearish imbalance. Now what does that mean for me? That means that I'm mainly focusing on shorts and I'm not looking for early reversals. I'm just looking for these bullish trends to play out and then quickly capitalize on short entries once prices are pushing back below exponential moving average. Now you can see that the lows are static and the highs are lower than the previous one. And a lot of times when you see this bearish imbalance in the trading range, you can find a potential wider trend line that is not going to be valid from the standpoint of trendline rule, because it is a trading range and this pattern would be too wide for a trading range. But this is how you can understand the fact that there is a bearish imbalance. You will most likely not get a break in a retest of a new extreme because this is a trading range structure. So you don't want to take this too seriously, but I can give you an idea what the structure is. And now it makes sense that this is a bearish imbalance. And for that reason, once you're bouncing off of these lows, you're not particularly looking to go long just yet. You're just looking for shorts. And same thing right here. Once you're bouncing at the low of the day, this is not a healthy trading range where I would want to find a quick reversal. No, I know that once I see a 2 legs up or break a new high, if we push below EMA, I'm going to resume the downtrend and I'm not going to look for a quick reversal unless we get the proven trend in opposite direction. Here we have another similar example structure-wise. We can see that this is a trading range structure. We can see that we have a trading range in the middle, but there is bearish imbalance inside of this trading range and inside of the overall bigger trading range. Each new high is lower than the previous one. The lows are static, but they eventually keep breaking lower and they are lower as well. So this is what we call a bearish imbalance. And we're not particularly looking to take failed second entry short just yet, unless we truly get proven trend in the opposite direction, because this is a big trading range. And at this point on, you can also identify the trend line that will help you make sense of what the bias is. And once again, once you have a break, you don't expect to get retest of a new extreme, because this is not a trend line to pay attention to. This is a trading structure. But it can give you an idea that there's a bearish imbalance in this market and you never want to be buying too quickly because you can get trapped on the wrong side of the market. And today's structure was basically just a smaller version of the previous examples. When I'm going to identify the high of the day, I'm going to see that we keep creating series of lower highs and we have bearish imbalance in this trading range. And there is potential trend line that can be drawn and make you understand what kind of bias this is. For that reason, even though we're breaking below this trading range, I'm not fading the breakout, I'm not taking long entries, and once we bounce here at the low of the day, I'm not looking to take reversal pattern just yet. Instead, I wait for this reversal pattern to fail and I look for more short entries. Only after when we push strongly to the upside like this is where I get proven trend in opposite direction and I can potentially start thinking about long setups. Today started with a strong downtrend working lower, and it looked like it's going to be quite easy day. For that reason, when we have break for this channel, we expect, according to trendline rules, to get new extreme. And already there was a little bit of a confusion because there was a strong push above exponential moving average. The EMA didn't reject prices at all, so there is no high probability setup for us at the exponential moving average. However, the main pattern was down and I still expect the low of the day to be reached. So I see a break, I see 2 legs to a new extreme, but I'm not looking to go long just yet. Remember, this is the bigger pattern and it takes precedence. So there was push below EMA and there was a lower high, but lower high is way too big and the first bullish bar closed so far above exponential moving average. It didn't even manage to close below. So I really needed to see a failed second entry long for me to go short. I don't think you want to go short just yet because the bullish bar was big and it closed above EMA. Had the lower high form below EMA, that's when you can make a case for it. But once you push so strongly above EMA, I want to see more confirmation. And notice what happened. Prices pushed back above exponential moving average and EMA kept holding. And now it's starting to get really confusing. Now I know that the bigger pattern is down and I know that we still are in the middle of the trend range and the bias is still bearish. For that reason, I'm not going to be drawing a wider pattern like this, just like we talked about in our last video, when this is not a great pattern to take into consideration because the structure is not uptrend like this, it is a downtrend into trend range. It is a little bit confusing because it keeps creating a couple more pushes to the upside, so it makes you believe that there may be a potential wider uptrend, but this is not one of those structures that you want to focus on. You really want to still expect to get new extreme and you really don't want to be going long just yet. Since the exponential moving average keeps holding prices, I cannot go short unless we get a strong push below EMA, but I don't want to go long just yet. So this is just waiting area before market eventually resumes. And you guys can see you keep pushing higher. It keeps trapping a couple more bulls, but eventually market continue pushing lower. Now the first high probability setup that I see, because this is a new low and we have a first entry short pullback, second entry short, notice the resistance, the important area where prices previously turned multiple times is holding, is a great bearish bar, and it is confirming the idea that you're at the top of the move and you're going to reach new extreme. But notice the EMA is getting a little bit flat. The bars are not too stacked, there's a room between, but you can see that this is a sideways movement, but this is a second entry short off the range highs, nice bearish bar. So first decent entry to take a chance on. Market created a break for the downtrend and new extreme was formed. And now you can see that this confirmed the fact that we may have start of a bearish imbalance, because I'm going to put my key level at the high and this upper half of a trend range is completely empty. So my goal right now is to reach the low of the day. Now I still need to draw my short-term corrections. We have a move up, break, another leg up. So this uptrend played out when there's a break and new high, following the trendline rule. This is the first leg up, pull back, second leg up. The trading range is coming into play, the resistance is holding, but at this point on, it's a little bit too stacked, no good entry, and market kept pushing lower. Now at this point on, it is clear that we have the bearish imbalance that we identified earlier. I'm looking for short opportunities. I'm not looking to go long. And we have new low, first entry short, pullback, second entry short, but signal bar is way too big. I don't even want to enter this with the limit order because at this point on, this is really big. But notice what you have. When I was watching this, I still wanted to go short. Support now acts as a resistance. This is a breakout pullback pattern. EMA keeps holding prices. This resistance is holding. It is a lower high after second entry short in bearish imbalance, which means I'm going to most likely reach the low of the day. So this was my trade that I took and I got stopped out here. It didn't manage to get the scalp. It reversed on me and soon after it quickly pushed to the downside where I thought it was going to go. So this was one of those little fake outs, probably a little bit too early, but I'm going to take a chance on this entry anytime. And eventually it did push lower. There was this little fake out. They needed to trap a couple more bulls. Now, just because we reached the low of the day doesn't mean that we start looking for longs. No, we're going to take a step back and identify the bearish imbalance is kicking in. Each new high is lower than the previous one. You can draw this trend line just to get the idea. We have a new low form right here. I reset the count here because the lows are matching. And we have a first attempt to sell, pullback, second entry short, failure. Now when I was watching this, I didn't want it to go long because it is too early just yet. There may be a potential another leg down. It's very typical during imbalance like this. So once I see everybody going along here getting trapped, it ticked high, reversed down. This was my second trade for the day. I managed to take a quick easy scalp, but this is quite aggressive entry because the better setup would be to get a new extreme and then take a lower high or failed second entry long. But those setups didn't really form well as well. The lower high is a little bit neutral looking. EMA at that point is a little bit too flat. It's getting a little bit too sideways, and failed second entry long is too far down. You managed to get 6 ticks, but it is way too far down, close to these lows. So it's too late. But I like going short here as a failure of the failed second entry short, just for a quick easy scalp. And there was the last push down. And when you tested the key level again, this is where you suddenly start going sideways. And at this point on, once prices bounce here, we are not looking to go short anymore because the key level is getting proven. You don't want to go long just yet. You only want to go long after you see a proven trend in opposite direction, which happened right here. And then potentially you may start looking for longs. So you're going to draw the short and trend lines. And remember, you're not really trying to identify any wider patterns, just like there can be a wider pattern like this. And once again, this is not really the pattern that you want to be focusing on. You can see if you study these uptrends in these trend ranges, the price action doesn't work that way. So the only thing I can do is to follow the shortened pattern, shortened price action, which I have a break new high. I have a consolidation, multiple overlapping bars. I cannot really take a guess in this area. You're kind of hanging in the middle of trend range as well at the upper half. So no clean entry, market continue pushing lower. So you would expect we would eventually reach the low of the day following trend range rule, because this is right now a smaller trend range inside of this bigger one, the 2-tier trend range. But there was a V-shaped reversal back up. Market continued pushing higher without any good high probability setup. Then you broke the resistance and tested it, and now it acts as a support. You have this uptrend working higher, and this is the first break, and according to trendline rule, we're going to get most likely a new extreme. And this is a new high. First entry long, pullback, second entry long, big bullish bar. It is a little bit stacked. Notice 1, 2, 3, 4, 5, 6, 7 bars stacked. I would have preferred had this candle close with the body at the EMA, which this would have made it a little bit filled breakout to the downside. But this is definitely one of the better entries today. Second entry long and downtrend played out with the break and new low, indicating to you that sellers are no longer active and you expect new high. 2 key entry points are holding prices. Quick, easy trade. After that, you have a new high, which tells you buyers are no longer in play. You're not looking to go long, but at the same time, you cannot go short just yet. You're still above EMA and you haven't pushed and stayed below EMA. Every setup is above EMA, which you don't want to take a short just yet. Strong push below EMA, and just like it happened right here, there was just additional reversal and market continue pushing higher. Now notice, every single time you are finishing the push phase, you have to be a little bit careful at going long. And in this instance, you have a new high, first entry long, second entry long, but notice the signal bar. It is a bearish signal bar and you cannot go long above bearish signal bar. And at that point on, it is starting to get too stacked. Once you see congestion like this, you don't want to keep going long, even though it would have worked. So remember, you want to keep buying preferably once prices are pushing above EMA somewhere around here for a second entry short, or to get a second entry long before you exceed these highs. But once you push so far up, now you're too overextended and you're going to pull back into this trend range. So I don't want to go long here. At the same time, I can't go short again. And after that, there's a nice downtrend starting. I need to identify my channels. There's the first break for the downtrend. We expect to get new extreme, but you have first entry short, which means I have to reset the count and I have another first entry short. Had there been slightly higher low, at least one tick, this would have been 2 leg up pullback, first leg up, pullback, second leg up. This would have been decent high probability setup. But according to rules, this is only first entry. I can mark it as a slightly aggressive entry, but I really like to reset the count here and I like to treat it as a first entry. So you're taking a chance here, but it is a visual 2-legged pullback. Then we had short and uptrend, break, new extreme, second entry short, new low, first entry short, second entry short, triple top, triple test. But then again, look at the horrible signal bar, no entry, and at this point on, it is too late and market is ready to close. We went through the examples, and every single time you see one half of the trading range being empty and you see series of lower highs or higher lows, there's possibly imbalance, and you want to stay on the side of the imbalance until structure changes. A new pattern will start. At this point on, there was a new trading range at the bottom half of the overall trading range.